In early 2020, the COVID-19 severely depressed the economic activities in the United States. It almost caused a recession. In response, the government stimulus program, coupled by the Federal Reserve policy of keeping interest rate at a very low level, almost equal to zero, increased the money supply, and consumer savings were also increased. Altogether, they created a pent-up demand which was much higher than the supply of available goods. This situation was exacerbated by the supply chain bottlenecks, which further constrained the availability of goods and services. The result was a price pressure which created an inflation rate of almost about 7 to 7.5% in 2021 over 2020. What's going to happen to the inflation rate as we look further ahead? The inflation rate is going to go down in the last 2 quarters of 2022 and also through 2023. The reasons is that A, the Federal Reserve is going to pursue a policy that is going to increase interest rate. They are expecting right now probably 3 interest rate increases, roughly around 75 basis points altogether. Then there is going to be an alignment between the demand for goods and also the supply of available goods, and we further expect that the supply chain bottlenecks might improve as we look further into the future. However, it is very important that the target inflation rate of 2% may not be with us into the future as we have expected and we have been comfortable in having it over the past 5 to 10 years. The estimates by the economists is that the inflation will settle somewhere between 3 to 3.5% in the next 3 years. What is important is that even at this rate of inflation, companies would be able to produce and the economy would still grow because of the profitability of innovation and growth.